Sturgis Credit Repair is a 5-star rated online credit repair company. We help people just like you build or rebuild their credit scores. If you have no credit history, we offer products to help you build credit history so that you never have to depend on anyone co-signing for you. If you have bad credit, enroll into our service today and allow us to work on the negative items affecting your credit scores. We take no money up front, so start our service today for free. You'll get updated through your online account as well as receiving updates through your email. For those who are trying to buy a home, we're partnered with multiple real estate agents and loan officers who are ready to assist you with your goals. If you are a real estate agent, loan officer, or anyone dependent on customers with good credit, create a free partner account with us today. You can manually send or receive clients through your online account as well as track their progress before they go to someone else. Visit our website to learn more about our services. All right, let's talk about when should you refinance. So someone reached out and they asked, hey, I had this vehicle for 2 years now. Is this a good time to refinance? And one of the biggest things that's misunderstood with loans, whether it's a vehicle or a home, is when it comes to refinancing. A lot of people think whenever they've been paying on a car loan for 2 years, they can refinance. That's not the case. If anything, things can get worse if your debt situation has increased or your credit card has gotten lower since you originally bought that home or that vehicle. So attempting to refinance only because you've been paying on the loan for 2 or 3 years, and that's the only thing positive that happened, that doesn't mean that your interest rate is going to get lower or that your monthly payment is going to get lower. So let's go through these first 3 steps here on ways to know when you should refinance. So I can't really answer fully when's the best time for someone to refinance because everyone's situation is different depending on what their long-term goals are or how much they can afford monthly. So number one, credit scores change. So if you apply for a home loan or a vehicle loan a few years ago and you had a 600 credit score and you got an 8% rate, well, now your credit scores are 700 plus and you can qualify for a 2 or 3% rate, then yes, you should go ahead and refinance because that's going to save you a lot of money, with a monthly payment. So if your credit scores have increased to put you in a next category of, of risk, then yes, by all means, go refinance that loan and save you some money on a monthly basis. Now, if you had a 650 credit score and now you're a 680, you jump 30 points, that's not going to do much. Save the hard inquiry. Don't go out and start applying for stuff because you haven't really changed much to put yourself in a different situation. So if you already got approved for the lowest rate possible on a car loan or a mortgage loan, and your scores went up a little bit, it's pointless to go out and try to refinance that loan because you're not going to get approved for anything lower. So I wouldn't go out and refinance just because I owe less than the loan, but I get the same interest rate. Refinancing, the whole purpose of that is just getting a lower interest rate and you pay back less money in the long run. So we'll talk more about monthly payments on step number 3 after we get done with the second step here. So number 2, money saved up. So let's say you saved up some money. So you bought this home or you bought this car 2 or 3 years ago. You put 0 down or you only put the minimum requirement down, which caused your interest rates to be high. Now you got some money to put down. So is it a smart thing to refinance? In my opinion, yes. If you got a high interest rate or a higher interest rate than what you can get approved for now, and you got some money saved up, yes, go and refinance. Let's say you had a $30,000 car loan and now the loan is like $26,000 2 years later, but you got $10,000 to put down. Well, your new bank that's going to refinance the loan is going to buy out that loan for $26,000. And keep in mind, you were originally paying a monthly payment on a $30,000 loan. Now you're at $26,000. Now you got 10 grand to put down, which means you're only paying a note on a $16,000 loan. So that's going to cut your monthly payment almost half from where you originally was paying a monthly payment on a $30,000 loan. So if you saved up some money put that money down. There's usually a few mixed opinions on whether you should refinance or just put that money towards the loan and pay it off completely. So let's say if it's been 1 year on a 6-year car loan, then putting 10 grand down probably won't help you much, because you still have 5 years left to go in that loan, and 10 years isn't really gonna, 10 grand isn't really gonna make a big payment change, or not big payment change, or a big change with the overall loan, because you still got 5 years to go paying that exact same payment. Or if you refinance, you still got 5 years to go in that exact same payment. So I would usually refinance and just save the money that I was paying monthly and then pay off the loan the second time. So if I had $10,000 saved up, I would finance less, and now I can afford more money or more stuff on a monthly basis. Because if I had 10 grand, I threw that away to a car loan, I'm still paying that same high monthly note, then I'm saving the same amount of money every single month. I'm not saving much. But if I use that 10 grand to refinance, and I went from saving $500 after all my bills, now I'm saving $900 after all my bills, then yeah, I can, that's $400 more a month that I'm saving. And now another year, I can do the same thing over and over and then pay it off within 2 years or so. Number 3, paid the loan down. So that goes back to what I was saying right after, between number 1 and 2. So if you paid a good amount down, for example, let's go back to $30,000, and now you're down to $15,000, and you cannot afford to pay off that $15,000 balance within a year or two anytime soon, and you're still going to be paying the same high note for 2, 3, 4 years from now, then yes, go out and refinance if you paid a good bit of the loan down. Because instead of paying a monthly note based on $30,000, you're now paying a monthly note on a loan based off $20,000 or $15,000. That note is going to go from $600 a month to hopefully $300 a month. So you only refinance after you paid a decent amount down, only if you know for a fact you cannot afford to pay off that loan anytime soon. Because if you refinance, you're steady paying interest, so it kind of defeats the purpose of refinancing if you're going to pay the loan off within a year or within a year and a half. Just stick to that high note and just save your money and just pay it off in one big check. But if you know you're going to be paying on that loan for a few more years, go ahead and refinance so you can save more money on a monthly basis and then pay it off even quicker with that. So those are the 3 steps I have when it comes to refinancing a home. I'm sorry. So rather you refinancing a car or a home, these are the 3 steps you need to follow. If everything checks off good and it makes sense to you, go for it, pull the trigger, refinance, save some money, pay that loan off even quicker. And that is all for this. If this video helped you, be sure to like it, comment, share it, and subscribe to this channel for more helpful videos like this one. Thanks for watching.